Gentlemen, good to see you. Barry, last night you said yesterday's comeback was a head fake, and you've got a list of things that you would need to see to believe that we are sort of out of the woods. What are some of them?
Yeah, if you think about it, Carl, the Fed really needs to pivot more to dovishness at some point. But if they do it now, before the first rate hike in March, clearly they would lose all their credibility. So I think there'll be a lagging indicator there. We have to look to the market indicators to know what's going to happen on the rates and the balance sheet at the Fed. The 10-year TIPS yield, which is the basis of the TINA, there is no alternative trade, has been negative. It ended last year at minus 1.1%. It's up to about minus 65 basis points now. You're getting a negative real return from equities for the next 10 years. So what you do is you buy risk assets. And as that real yield climbs, it's pretty negative for the growth stocks. The last thing is the PMI manufacturing. You know, I think that's going to fall abruptly. You mentioned the Richmond data. We use the regional Fed surveys to triangulate on the PMI. That comes out the first of the month, and that correlates with S&P year-to-year change, earnings, industrial production. We're looking at China's stimulus, the dollar, when will it top, the dollar versus the Chinese yuan, which has been the latter very strong. And so if that weakens, it's going to drive the dollar up. It's a disinflationary shock. Earnings beats versus misses, and Ukraine, of course, is a very big oil and gas issue. But those three things, the Fed, the TIPS, and the PMI, are really front and center in why we think the market consolidates here.
Yeah. Richmond Fed, as you mentioned, comes in at 8. Prior was 16. Sam, for those who are hoping that earnings can make up for some multiple compression in the face of all of this, I wonder if you think GE, Raytheon, J&J are anywhere near a good enough head start.
Well, I think that it's nice that we do end up with some earnings beats early in this fourth quarter reporting period. But I think that with the Fed raising rates, with the 10-year yield creeping higher, at least over the longer term, I think that we are going to be continuing to see PE contraction. Going back in time, essentially, you've had a negative 0.5 correlation between the 10-year yield and PE ratios. And with us starting the year in the low 20s, I think we would have to fall by at least 15% peak to trough in order to get to the top of the range of PE ratios experienced between 1.75% and 2.25% going back in time.
So, Barry, I mean, given those factors that you just outlined that you're watching where equities are concerned right now and the broader markets, it sounds like you think we may have further to fall. I mean, given the fact that the selling has been so broad-based, we got every sector in the S&P lower today, everything from the Russell to the transports to the major averages lower today. Does an investor just put their money on the sidelines and wait, or are there actually buying opportunities here?
When you have an environment where the growth is slowing, the Fed is exiting, and you have the PMI particularly, which, as I say, we've regressed every variable against the market sectors and industries for the last 25 years, and it's one of the best economic indicators. When that occurs, you want to go more defensive. So that would be consumer staples, healthcare, some utilities, some of the telecommunications, some of the REITs. And that's where we would hide out in this first quarter, because I do expect the first quarter to have more downside volatility. We will not know what things look like until late in the quarter, certainly not the first few weeks of the quarter, to make a decision on the rest of the year.
Shepard Smith here. Thanks for watching CNBC on YouTube.